Welcome back to another episode of Investing Explained. Here's today's question.
You know, I personally can't stand bonds right now, and most of it just comes down to the fact that you're getting almost no yield after you account for the inflation, which completely impacts the bond. You're really getting nothing. And on top of all of that, you're in a position where central banks, at least here in the U.S., are raising rates, which is not good for owning bonds. Now, if you're owning a short duration bond, it's not going to be impacted nearly as much. But anything that's long duration, I think you're going to have not a good 2019 if you're sitting in bonds.
And the reason why you would say that, Preston, that it's about duration, basically what you're talking about is if you have a 1-year bond, you might only get, say, 2 semi-annual coupon payments. So it really doesn't matter what the interest rate is doing. But if you have, a 30-year long bond, then you have a lot of lower coupon payments that compared to if you bought that. But Santosh, I think it's a good question that you bring up right now, because if you look at the yield of the 10-year treasury, right now is 3.2%. If you look at the Shiller PE, a key ratio that Preston and I have been looking at quite a few times here on the show, it will also give you 3.2%. So you might be thinking, why would I not invest in bonds? I think that makes a lot of sense to bring up that question, because would you rather have 3.2% that is safe because it's risk-free, it's issued by the government, or would you rather have a 3.2% giving everything we talked about here on the show with the huge drawdown that we see the market could do here over the next period of time? That being said, I'm still in the same camp as Preston. I don't own any bond at the moment either. I don't find the yield attractive right now. Of course, you can make an argument that if something really goes wrong, the central bank would just cut the rates and you would see the value of your bond go up. If that is your strategy, you have to be really good at timing, that's for sure, because we see rates climbing up right now. Just to give you an indication, here at the start of the year, the 10-year treasury was selling at 2.46%. And before talking about rebalancing, which you also bring up, you should also keep in mind that the capital gains on bonds are typically different. You pay them every year because you get your coupon every year. Compared to a stock, you incur the tax when you sell it. Typically, you could be a bit more liberal with the stocks in terms of taxes. And that really takes me to the other thing about rebalancing. I don't think there's anything wrong with rebalancing, but I would definitely consider the tax piece here if that's what you're doing. Going into a rebalancing strategy, depending on how it's set up, it can be very costly for you if you're buying and selling too frequently.
At the same time, you also have to be aware of what inflation is doing, because the bond market is repricing things based on what their expectation for inflation is. So earlier in the show, I said that my expectation here in 2019 is that you're going to see the central banks eventually get to the point where they've got to capitulate or hold their rate rises, right? I don't know when that will happen, but I would expect it to happen in 2019. So if that would be true, that's whenever I think you're going to see the price of commodities go up, which means your inflation rate's going to go up, which is more pressure to the bond market, even though the central banks would then be holding their and not raising rates. So I guess that's why I'm just so negative going into the coming year with the bond market, is just because I think that even if the central banks don't get you, I think that the inflation that we might see could potentially get you as well. But we'll see. We'll see how right that call is, and we'll keep track of it as we continue to progress in the show, and we'll continue to talk about these topics for sure.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.